And what's happening once again, options traders? Well, I thought this would be a perfect time to talk about when stop orders can backfire. And I'm talking about mid-June of 2022 when we've been experiencing all of this volatility. And even later today, we are expecting a Fed announcement. 75 basis point increase is what the market is anticipating, but a lot of volatility at this time. And because of this, traders often turn to stop orders as a way of risk management. Now, I've talked about my concerns with stop orders in previous videos. As a general rule, I'm not a big fan of them, especially for options. But what I wanted to point out in this video is when there are times that they can definitely backfire, and you really have to figure out which side or which belief you're taking about the movement in these prices. So let's go see what that means and give you some better ideas to think about before you set those stops. So before we get started, as always, please click like and subscribe. I definitely appreciate it very much, and it helps so much to promote the channel. So there's a few little building blocks that we have to figure out first before we look at the problems. The first one is, go back to a previous video about the current market price. We've talked about mark to market. This is why your broker's platform shows the current market price of your position. It's always marked to the closing price of that day. And the reason that's done is that that's really the way that you should see the risk. So if you buy an option for 3, you often hear, oh, this is the most you can lose. Well, sort of. That's if you just bought it right now and it's still worth 3. But what if it climbs to 10? Are you still going to make the argument that you only lost 3? So we always have to consider the current market price as our risk. All right, so remember, risk equals the current market price. This is what you have at risk. It is always changing with market conditions. So for instance, if you buy shares of stock at 100 and the current price is 90, you really shouldn't say, well, I'm down 10. Well, even though on one hand that's true, the better way to look at it is that you have a position worth 90. What would you do here at 90? Would you rather be a buyer here at 90 had you not purchased those shares? Do you think this is a good place to enter? And if the answer is yes, then you'd have to think twice about getting out. See, the fact that you've got a $10 loss right now is a sunk cost. It just doesn't matter. It's in the past. There's nothing we can do about it. The better question is, what should we do at this level? And that's where it can be dangerous, whether you're just selling a position out or using a stop to do it for you. In this example, you say, well, it's fallen 10%, so I want to get out. But what if you really thought, had you not been in that position, that this would be a better place to enter? Well, then that would be a terrible place to get out. All right, so that's the first thing. Always remember about the current market price represents your current risk. Any losses that might have accrued in the meantime are sunk costs. They shouldn't be part of your decision because there's something that occurred in the past. Okay, so that's the first thing. Second thing is momentum strategies. Momentum is this idea that the trend will continue. And this is why a lot of people get into a trade. They go, wow, look at this stock. It went from 100 to 105 to 110. It's got a lot of momentum behind it. Let me get in now at 110. Why would you do that? Because you think it's going to 120 and 130. That's the whole idea of being a momentum trader, that you're getting in after the fact. And there are certainly a lot of times when momentum trades can make sense, but that's not really what's important right now. What's important is that you need to figure out what you are at that moment. Sometimes you might be a momentum trader. Other times you might be leaning towards mean reversion. So mean reversion strategies, recall, mean that you are assuming that the trend is going to reverse. Prices tend to, at least in a lot of cases, oscillate. They'll go up for a while, they hit a certain level, and then they tend to cool off. And they'll pull back for a little bit, at least to a certain level, and then they will reverse. So this is the third thing that you have to understand, is this idea of mean reversion. So all of your strategies generally fall into one of two camps. You're either looking for momentum or you're looking for mean reversion. So this is the whole idea and the basis for understanding why stops can backfire. So if the price is at a level where you'd expect prices to bounce, then don't use the stops. And unfortunately, a lot of times this is where traders are placing their stops. For instance, they might be looking at a Bollinger Band and looking at the very bottom of the band and saying, oh, if it gets down here, let me place a stop. Well, that's probably the worst place for it. So if you are expecting the price to continue in the same direction, all right, then stops might be an acceptable risk management tool. There's still some other arguments against them, but at least I could say it would make some sense to do that. But again, unfortunately, traders often set stops at levels where the stock has fallen sharply, which probably means it's primed to revert. And so again, this is the whole idea of where these stops can backfire. So to see this in action, let's jump over to the E-Trade platform and take a look at an example. All right, so now we're into the E-Trade platform. I'm going to use Microsoft for the demo. It's currently trading up about $4.50 at $249, almost $250. So good little bounce off the opening here. But down below, we see the prices, and I've also overlaid Bollinger Bands. And the basic idea of Bollinger Bands is that when prices get up towards the top, they will tend to reverse all the way back to the bottom band. Once they hit the bottom band, they tend to reverse all the way up to the top band. I do have another video in our forum here talking specifically about Bollinger Bands, but also recall that they can do what's called riding the band or walking the band. So just because it touches up here doesn't mean it's immediately going to reverse. It's just saying that once it does reverse, it will tend to go back to the other band. So again, if you go back to, let's say, this period of time, this was in about April of 2021, and if you look here at this top, and traders might be saying, oh, you know what, we got this gap down, we're moving down, let me put a stop in here. And they look and they say, well, based on where the stock is right now, I'm willing to let it fall a little bit more. So they put their stop right here, and you're real close to a major moving average, real close to a pretty significant pullback, fairly close to the bottom of the Bollinger Bands. You're probably in a much better spot to expect it to revert. And this is exactly the point where you're getting out. And there it goes. See, this is why so many times people always say, oh, the market saw my order going in, and that's why everybody reversed it. Market makers reversed the price. And this is why. It's because by the time you're feeling that pressure and you're finally thinking it's time to take action, it's probably at exactly the wrong time. So you weren't thinking about placing a stop back in here when things were going well, even though that's what you should have been doing, or hedging or rolling or morphing in some way. People wait until prices change, they start feeling the heat, and then they place a stop, and the very moment they get triggered out is when the stock reverses. Here's another case. We get up to the top of this band, we see the prices start to roll over. What happens? Traders go, oh, looks like it's starting to roll over. Let me place a stop. Let me place it down at around this level. And where is that? Right at the point when it's about to reverse. And there it goes. So the whole idea of this is that you have to think of what kind of trader you are and why you're setting the stop. So coming back to this level, if you saw the prices falling here and you said, you know what, I'm really convinced they're coming down here possibly, if they maybe break below this area, all right, well, fine, then go ahead and set a stop. But if you're just feeling that it's getting to a relative low point, and especially if it's getting near a support level, flat lines, moving averages, Bollinger Bands, you're probably getting into an area where it is more likely to reverse. But either way, you have to make that decision before you place that stop. If you feel that this is an area where the stock is likely to reverse, and had you not entered the position, maybe back in here, would you be more likely to enter it here? And if you're looking at it going, well, if I didn't have this big loss, yes, I'd be willing to enter it here. Well, then that's a horrible place to exit. And the losses don't matter. They are sunk costs. Always look at each trade on a standalone basis, not counting what your losses are. Those are sunk. Figure out, would you rather be a buyer or a seller right now? And if you're feeling that the momentum's going to carry you down into here, fine, place that stop. But if you're leaning towards, you know what, I almost think I'd rather be a buyer down here, you have to really question if it's a good idea to place a stop, because that's probably the perfect place for it to backfire. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find the link in the description below.